Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Show with Dave Lindahl on multifamily apartment investing in emerging markets. I'm Dan Breslin, host of the REI Diamond Show. On this episode, by popular request, I've invited Dave Lindahl to share his wisdom on timing the multifamily apartment complex real estate market. Dave has bought and sold thousands of units over the last 18 years and has owned as many as 8,400 units at one time. We talk about some very interesting topics, including the 4 phases of a real estate market, how to hedge against rising interest rates, and the indicators and information sources for identifying an emerging market before the prices climb too high. You'll probably want to listen to this one more than once as Dave rapid fires his real estate investment jewels of wisdom. Enjoy. I am here with the man, the myth, the legend, Mr. Dave Lindahl. Welcome to the call, Dave.
Hey, Dan, what's going on? I appreciate you having me.
Yeah, man, things are going well here in Chicago. How about you, Dave?
It's always beautiful here in Boston, you know, whether it's cold, warm. It's God's country, you know what I mean? Sometimes it's so cold you walk out the door and you say, oh, God. That's what I call God's country. I'm sure you get the same.
Yeah, we have a similar experience in the winter time in Chicago. Yeah, I know a lot of our listeners have been excited. You were suggested, people suggest guests through our website at REI Diamonds, and you were suggested, so I made an attempt, reached out to your office, and I'm grateful that you were able to come on the show. But for those of the people listening that don't know who Dave Lindahl is, can you give us kind of the Reader's Digest of how you got started in real estate and what your business looks like today, Dave?
Yep, Dave Lindahl, when he was 16 years old, left home. This is going to be the Cliff Notes version, but left home to join a rock and roll band. I was in that band called Flesh Picnic for almost 8 years, and I was a lead vocalist. It was great. I had a lot of fun. I burned a lot of brain cells, and then I realized that I needed to do something else because I wasn't going to make it in rock and roll. So I came out. I sold memberships to BJ's Wholesale clubs and Costco's. I thought, well, maybe I'll start a landscaping company. It was April in Boston, and the grass started growing, so I started knocking on doors, started mowing lawns. When the winter came, I struggled. A friend worked for a bank. They were foreclosing on properties. He asked me if I wanted to do the rehab on a property, so they could resell it, not if I wanted to buy it because he knew I'd broke. I said, sure. I got my cousin to show me how to bid it, and then I got my cousin to show me how to do the work on it as well. And then I got really good at calling contractors. Actually, I got good at calling contractors. After that one went well, the bank asked me to do another one, and I did that. And then the third one, and I started calling contractors to do the work because I was never really good at doing the work, but the bank was happy. I started realizing that there were either homeowners or investors like us buying these deals. And at the time, I wasn't an investor, but they would ask me all kinds of questions like, what's wrong with the property? And I would ask them all kinds of questions like, what are you doing and how do you do it and how much are you going to make? I would probably make $4,000 or $5,000 doing the rehab for the bank, and they were making like $20,000 or $30,000 just taking the property and flipping it. And I thought, that sounds interesting. So I got the Carlton Sheets course. Remember Carlton?
Oh yeah.
Yeah, I got his course, and then I put it on the shelf, like a lot of people do. And then he came out with a new and improved version. And I got that one, and I actually opened that one. And what really turned it around for me is I joined my local real estate investment group. I joined a group like yours. I just started absorbing as much information as I could from wherever I could get it. And back then, this is 18 years ago. So back then, Amazon wasn't around. The internet hadn't been invented yet. And so it was going to the bookstores and going to real estate investment groups mainly to get information. To make a long story short, I started with multifamilies because I heard about this guy in New York City that said that people that rent apartments will pay you to own the buildings. They'll pay for all the maintenance that needs to get done. They'll pay, have a management company manage them for you so you don't have to deal with any tenants. And then they'll pay you so much money that at the end of the month, they'll actually give you more money than you'll need to spend. And you have positive cash flow. And I thought, wow, that's true. And if you can get into these deals with no money, because I had one, then I want in. It took me 9 months to really figure it out. There's nobody out there teaching how to do it. And it took me about 9 months to get over the fear of doing my first deal. But I got the first one. And then when I got the first one, I had, within 3 months, I had 3 more. Within 6 months, I had 9. And within the first year, I had 11. And within the first 3 years, I had like 40 of them. It was great. It was just crazy. And then from there, so 3 years into it, I realized that, man, I'm making a lot of money. I get a lot of passive income coming in, which is great. I have a lot of money in equity, well over $2 million in equity. I realized that what goes up must come down. And I did so well because I was in the right phase of the market cycle. And if I didn't either sell my properties or move them to another market that was in the lower half of the market cycle, like the rising part, I was going to lose all of my equity. So I started learning about, what moves markets, what might be good places to invest. And I discovered that it was jobs that move markets and follow the job growth. One of my mentors taught me, he said, follow the job growth and the jobs will lead you into fast appreciating areas. So I did. So I went down to Montgomery, Alabama, and I bought a 40 unit, which I was really afraid to do. I was afraid to buy anything bigger than a 3 to 6. But I had so much equity in my deals, in order to do a 1031 exchange, I had to buy the bigger one. So I bought a 40 and then an 80 and then a 350. I realized that, oh my gosh, it's actually easier to do these bigger deals than it is the smaller deals. So I reset my goals from 1,000 units to 10,000 units. And I've been buying and selling now for almost 18 years, and I think the highest I've gotten is about 8,400 units owning at one time, and I just recently, we sold the biggest deal in Texas, which the biggest multifamily deal in Texas, which was over 5,000 units. And that was starting this crazy kid from a rock and roll band who was just looking to create a better life for himself and his family. That's how it all started.
So that's wow. Here's Dave Lindahl for everybody on the call, not quite hitting your goal of 10,000 units. You must buy and sell a lot of them. Can you kind of describe your investment philosophy recently? I think you touched on it with trying to find the emerging markets, but
yeah,
if there was like a way to sum up kind of like your functioning or your operating in real estate over the last 5 years or so, and maybe going into the next 5 years or so, I mean, how would you describe that? What's the map? Look like?
It's all about market cycles. It's all about emerging market investing. So I've learned that there are 4 different phases of a market cycle. In each phase, you want to be using a different strategy when you're buying and selling your properties. You need to be able to recognize which phase you're in, and you do that with leading indicators, and a lot of it has to do with job growth, like I mentioned earlier. And by doing that, you can be investing in your own backyard. Like I've always been investing in the Boston and Brockton, Massachusetts area, because, knowing which phase of the market you're in, you can be making a profit. I call it making the most amount of money in the least amount of time with the least amount of risk. So knowing about market cycles and following them and understanding them will allow you to do that. So you can always be buying and selling in your own backyard. But at any given time, no matter what the economy is doing, even back in 2008 and 9 when the economy tanked, there are markets in the United States that are emerging. They're appreciating. They've got fast job growth going on. And the markets will give you a big reward for investing in them if you're buying good properties in good areas with the good numbers. And I can just give you a quick, for instance, back in 2008 when the economy tanked, in 2009, Little Rock, Arkansas had a 13% job growth. And nobody was talking about it because all of the news was all talking about the bad news and all the real estate bad news. But if you invested in Little Rock, you would have made a ton. Just to give, for those that are listening, some indicators, 2 key indicators that I look at. One is I want to see year-over-year job growth in an area be 2% or higher for 2 consecutive years. That's when I know that I'm in an emerging market. Now, it's like 1.5, and then it jumps to 2. Well, that might be a pre-emerging market, so I'm interested in that one as well. But a bona fide emerging market is a 2% year-over-year job growth for 2 years. And the other thing I look at is household formations. So I want to see the same thing with household formations. I want to see a 2% increase in household formations year-over-year for 2 years. That with job growth tells me that I'm in a market that's moving and it's going to appreciate rapidly for me. The other thing we do is we look for value adds in our properties. So a value add is a property that has a small problem, and when I say you, I'm talking about your management company. You fix that problem, whether it be a property that has low rents, a property that has low occupancy, a property that has lower than rule of thumb expenses, and then you always buy based on actual numbers. That's like the most important thing. You always buy based on actual numbers, okay? And when you buy based on actual numbers, we have a formula for that as well. And that formula is we call it the Holy Trinity. Because, when you first start investing, it usually takes about 20 deals of analyzing before you get one deal. And when that one deal hits, all of a sudden the sky opens up and this beam of light shines down and you hear a noise that goes something like, oh, right? Because you finally got a deal that works. And that Trinity is you need a capitalization rate of an 8+, you need a cash-on-cash return of 12+, and you need a debt coverage ratio of a 1.6+. Those 3 things together, that align like that will allow you to get somebody that has private money to invest in your deal, so you don't have to invest any of your own money. So a private money investor will be, those are the numbers that they look for, the minimum numbers that they look for to go into a deal. And at the same time, you can carve out 25% of the cash flow and 25% of the resale profit for yourself with those numbers. So all those three things, it's emerging markets, it's value add, and it's buying based on the Trinity, actual numbers based on the Trinity. That's how we become successful in this business. How's that? That's a lot in a short period of time, huh?
Yeah, you really are a great guest. I mean, you're hitting all the points. You're really. I literally wrote down before you started to say it. I said 2009. Where were you buying? And I'm looking at the paper, and then it comes out of your mouth. You said 2009, Little Rock, Arkansas. Yep. Is where you. That's wild. What did you guys do during that point in time? Was there a strategy change? Was it still the same strategy? Did you not really notice what was going on in the world of real estate around you guys? I mean, was it just Little Rock, or did you guys have a little bit more strategy going on during that time?
No, well, see, the real challenge came around 2000, at the end of 2006, 2007, when all of a sudden the numbers aren't making sense. You know, you've got out, you buy. You're a disciplined investor, so you're only going to buy based on these Trinity numbers. But yet you've got all these other crazy investors out there because the markets are, taking off and you're seeing fast appreciation that are buying based on speculation more than the true numbers. So you're losing out on a lot of deals. So you're not getting as many deals as the market takes off in these emerging phases, but that's actually an indicator that you need to pull back. You probably should be a seller and get into a cash position and then wait until the market tanks, which happened in 2009, 2010, actually 2007, 2008, and then you're ready to scoop up. So now, after the shock of 2007, 2008 happened and real estate prices real estate values came down because rents came down and people had a lot of foreclosures on their properties, there's a huge buying opportunity out there. So the thing is, we weren't buying it. We went through a period of around 2004, 2005, where we were averaging a deal and a half every month. And when I say a deal and a half, I'm talking about anywhere from 100 to 200 unit apartment complex. So we were raising a lot of money. We raised, I think to date we've raised over $102 million to fund deals. So we were raising a lot of money. We were doing a lot of deals. It was fun. And then all of a sudden the deals started drying up, and I was like, deals are drying up. The investors want to invest in more deals, and the numbers aren't working out. What should we do? Should we relax our parameters a little bit? It's like, no way. It's like, yeah, you can't relax your parameters. You just stick to your guns, and then something's going to happen in the marketplace. That something happened, and then we were prepared to go out and be scooping up other properties. Now, in 2009, 2010, I mean, maybe markets weren't starting to emerge yet, but markets will emerge, like the major markets like New York. D.C. was the first market to come out of the big recession. D.C., San Francisco, Los Angeles, which they say never cash flows, but does in the right market cycle. That you get good deals that in those particular markets that are cash flowing, that market's going to change and it's just going to take off. The markets on the coast, the primary markets on the coast are so dynamic. So that was one of our philosophies. Look at the major markets because we know they're going to move first on the upside. And so be bottom feeding. And number two, look for markets like Little Rock, Arkansas that have job growth in the midst of this, great recession. That's what we did during that downtime.
Interesting. So I think we were sort of touching on or dancing around it, but could you describe the four phases and, what was happening? Because I think that's a phase 4, if I had to guess, right, Dave, that you were just talking about? And then
I was talking about buyer's market phase 2. Yeah, it goes, so imagine a roller coaster, okay? Up and down, up and down. So at the very bottom of the roller coaster in the trough, that's the start of the emerging phase. And there is what we call the buyer's market phase 2. If you're listening and you're drawing this out, so go about 2/3 of the way up and put another line, okay? Between the bottom and that line is the buyer's market phase 2. From the line to just over the top, like if you're on the roller coaster and you're going over the other side, say you're at about 1 o'clock, make another line. I missed the seller's market phase 1. So you go about 2/3 of the way up and you put a seller's market phase 1. Go from the half to just about a little more than 3/4 up, and that starts a seller's market phase 2. So the seller's market phase 1 is the second half of the emerging phase. It's still a good time to buy, and I'll explain that in a minute. From that point, go over the roller coaster and then put a graph at make it about 2 o'clock, and then you'll have the start of a buyer's market phase 1. So we have the buyer's market phase 1 that goes to the bottom, and then you see the buyer's market phase 2 that goes about halfway up, and you see a seller's market phase 1 that go about past 3/4 of the way up, you have a seller's market phase 2. So the start of the emerging phase is the buyer's market phase 2, and this is when jobs start growing again. Actually, if you go from the very bottom, if you go up on the left, where it was going down, there's going to be a point right there where they're going to announce jobs coming into an area. And that is the beginning of the end, let's say. And that's when the local guys know that, who have been through a couple of different market cycles, that once jobs start coming in, when I say jobs, I'm talking about a company that is announcing 500 or more jobs coming into the area. Because for every job that comes in, there's what's called the multiplier effect. There's other jobs that need to be created to service those jobs, like the butcher, the baker, the candlestick maker. So those multipliers are anywhere between 3 and, say, 11. The first market I ever invested in was Montgomery, Alabama. They were building a Hyundai plant down there. They were bringing in 5,000 new jobs. The multiplier effect was 3. That meant a total of 20,000 new jobs were being created in the area. And it had a barrier to entry. And it's always nice when you're going into a market that has a barrier to entry. So the barrier to entry for Montgomery was the fact that it was surrounded by floodplains, and you couldn't build in the floodplains, which meant that as demand goes up, supply pretty much stays the same. So you see rapid increases in appreciation on the prices. So you see the job growth coming in, and you know that, the market's still going to go down a little bit, on these announcements, but it's only going to go down another 5 to 7% at the most, and then it's going to start going up the other way. And the reason it starts going up the other way is they pull the permits for these jobs. They pull the permits for this construction. The contractors come in, and the construction workers come in who are very migrant. They come in, they start renting apartments. Once they start renting apartments, they start increasing the cash flow of the building. Once they start increasing the cash flow, when supply remains the same, you start increasing the value of the properties. So then we enter the emerging phase of the market. Now, we know we're in the emerging phase of the market when rents start to rise for the first time after a number of years of being stagnant, because they just came down the roller coaster on the other side. So after a number of years of being stagnant, rents start to rise. That's like the big green light for all national investors like me who look for emerging markets. That's the big green one. If you want to be a contrarian investor and get in early, then you start buying at the sign of the job growth. And how do we know if it's good job growth or not? Well, we call over to the Chamber of Commerce. We call the Economic Development Committee. We ask them, what are you doing? What are you doing to incentivize these new businesses to come into the area, And if they've got a strong program and they've got strong leadership, then we like the market and we'll invest in the market. So now we're in the emerging phase. And the earlier we get into the emerging phase, the better, because all we've got is we got this whole huge amount of appreciation that's just waiting for us just because we bought at the right time in a marketplace. It transitions into a seller's market phase 1. When rents have risen high enough to support new construction. So that is when you made that second line for the seller's market phase 1. That's what we call equilibrium. Rents are high enough to support new construction. So now the contractors are in and they're building new apartment buildings. So at the beginning, we're only competing against, if we bought on the contrarian side, we're only competing against the local guys. When we go into a market, when we see that the rents have started to rise, we're now competing against the local guys and the national guys like me that are, emerging market investors. When you reach equilibrium, now you're competing against the people that are going to build the apartment buildings. And then there's this thing called the Affordability Index. And the Affordability Index tells you how much the average wage earner can afford for a single family house. When it's 1, that means it's an equilibrium. When it's higher than 1, that means the average wage earner can afford a good-sized house. When it's lower than 1, it means that the housing's getting tight and prices are getting higher. So when it goes below 0.7, that's when the condo converters come in and they start converting the apartments into single-family dwellings for sale instead of cash flow. They're doing it for sale. So what happens is when you're in the seller's market phase 1, probably about 3/4 into that phase, now you're competing against the condo converters. So I guess what I'm trying to tell you is the earlier you get into an emerging phase, the less competition you're going to have, the more appreciation you're going to get. So then something happens, right around the time these condo converters come in, and then, they start converting a whole bunch of properties. And if you're a smart investor, you're always watching the job growth. And once the job growth starts to slow down, then because I mentioned that right before the curve on the bottom side of that roller coaster, we've got the job announcement. Well, right on the emerging side, where it turns into emerging market phase 2, buyer's phase 2, we've got the job construction. And then after they start building all of these different facilities to house these jobs, and more jobs are going to come in because if it's a good, aggressive government and they get good incentives, more jobs will come behind it. I mean, they'll advertise in this magazine called Area Development. Other companies will hear about this job announcement that, Fidelity moves 1,500 jobs from Boston down to Dallas. Other companies will say, why? What are they offering down there, And they'll look into it, and then they could potentially move. Well, what happens is it all starts to build up the higher you go up the cycle, and then you'll get to a point what we call job fulfillment. And that's when all the construction workers have left the sites because there's no more else to build. The new people that are coming in to take over those jobs are in, so they're doing those jobs now. And then what's happening is the jobs start to slow down because the construction jobs are no longer there. The fulfillment jobs are getting filled up, and job growth slows. As soon as job growth starts to slow, you get out. You either get into a cash position, and if it's your own backyard, you're investing. You wait till the market to cycle around again, or you do the different strategies that you use for each particular cycle, or you move into another emerging market. You get in early, and then you just ride that wave again. So that is the start of the seller's market phase 2. Seller's market phase 2 is a very risky phase because that market's going to roll over somewhere. The problem is nobody knows where, so that's why you get out early. You leave some meat on the bone. Other investors will tell you you're crazy for getting out in this great market, but in reality, you're crazy like a fox because you're getting your money out, you're getting it into a safe place, whether it be cash or another area, and then you just move it. Now you just move it into that market, and then you see the appreciation. Now, there's another type of investing that you may do as well, and that's called legacy investing. And the legacy investing is when you're buying good properties in good areas and you're going to hold them for like 20, 25 years. If you're an emerging market guy, going from market to market, you're probably in the market from 3 to 7 years. But if you're a legacy investor and you're just looking, you've got wealth, you're looking to create more wealth and move it to your next generation, well, then you buy properties that are going to ride the downturn, the correction, and then you're just going to ride them through a couple of different market cycles on the way.
Can you give us an example of, one or two deals of the length of time, how it looked, how you got in there? Just pick a city, pick a deal. Maybe it's like long down in history by now, and just run through briefly what the numbers look like on that deal so we can kind of get a feel for that.
Yeah, we bought a property west of Dallas called the Wyndham. I know we sold about a year and a half ago, so we bought it 2 years prior to that. It was an assumption, so it was 264 units. We bought it for, I think, $8.4 million. There was a note on it for $5.5 million, so we had to assume that note and then come up with the additional equity on the money raised. On that particular deal, we wanted to upgrade a third of the units, so we actually raised an additional $320,000 through the investors, so we could upgrade the lighting packages, put accent walls in there, two-tone paints, things like that, so we could raise the rent $50 to $75. That's what our analysis said. And we were able to do that. We were able to raise the rents. It took us about just a little over a year to upgrade those units and then to get the new rents in. And we did some additional upgrades as well. And then about two and a quarter years later, we sold it for just over $10 million. So it was good. It was a nice profit in a short period of time.
Nice. And how did you find that deal, Dave?
That was through a broker contact. So you can get deals through this is a relationship business. So you have relationships with brokers. And I tell my students, go into the major cities, create relationships with brokers there, and they'll bring you into the secondary markets around those cities as well. So when we did Montgomery, our next stop was Jackson, Mississippi, and then after Jackson was Texarkana, Texas. And we met a guy that was a Dallas broker. Somebody referred him to us. We saw this property. We went down. We took a look at it. We liked it. It was a repositioning, which meant it needed some rehab. As we're doing the rehab on this property, we're noticing that this property fits all. This market, Texarkana, Texas, which is way east in Texas, and I'd never heard of it before. It's half of it's in Texas and half it's in Arkansas. That's why they call it Texarkana. And we realized that, wow, Texarkana is an emerging market. So we bought 2 more there, and then this Dallas broker brought us into, he got into at least 5 other sub-markets and a couple of deals right in Dallas proper. But we were in Longview, we were in Tyler, we were in Amarillo. All in all, we ended up in 11 different markets. But this guy didn't bring us in all 11 of the Texas markets. But we ended up in 11 different markets, 5 of them through this guy. So it was good.
What's your legacy investing? What are your legacy markets? Where do you like to hold for the long term, Dave, if any?
Well, Boston definitely because it's my own backyard. But I like, all markets have a flow to them. So the Atlanta market it takes usually like a 3 to 4 year cycle, and then they overbuild. And then, but then after it's down for about 18 months, it will start to cycle up again. So if you know the cycles and you know which submarkets are the markets that are the most solid, which most of the time it's uptown, the uptown market or the downtown market is the most solid markets. So we'd like to invest in there if we're going to do legacy properties. You know, I did so much in the Southwest and I traveled so much there that now all my markets are on the East Coast. So my priorities now are different. You know, my priorities are family. So I like to be able to fly down in the market during the day and be home by dinner at night. So it needs to be a direct flight for me, and it needs to be within like 3 hours at the most. And that would include, I still love Huntsville. I've been there since 2006. Atlanta's a great market. I love the Carolinas, Charlotte, Raleigh. We bought this great deal in Durham, which is just south of Raleigh. And then, you know, you get the Florida markets. So right now, the hot markets in Florida are the ones up higher. Jacksonville is a great market. I just sent a student down there, and he got 2 deals in 6 months. He's all happy. Jacksonville to the Cape Canaveral area, that's a really hot area. It's projected this year, 2016, 14% job growth in that area between Jacksonville and Cape Canaveral. Pensacola, we bought one there that's performing really, really well. That is the fastest growing city right now in Florida. So that's doing good. Port St. Lucie, that's a really good market right now in the Florida markets. So that's my bias. My bias is the East Coast, but if I was looking on the West Coast, I would certainly be I know Kansas City's not on the West Coast, but it's a good market on the way over there. I would be in Sacramento, the Inland Empire. The cities on the coast have already pretty much yielded themselves out. So I'd be in Sacramento. I'd look at Las Vegas because it had this huge shadow market when all those foreclosures happened in the single families that are pretty much burnt out now. I'd look at Reno as well, which is kind of like a hidden market out there. Oklahoma City is always a good market, and Tulsa is typically a good market as well. Plus all of the markets in Texas except Houston, which has no zoning, and Austin, which is just really, really tight to get deals there, and Beaumont, Texas, which I almost went upside down on 5 properties in Beaumont, and it was all because of the hurricane there, the big one over in New Orleans, and all the refugees went either to Houston or Beaumont. Houston could absorb them, but Beaumont couldn't, and it changed the market. We just didn't realize it because, you know, I had no mentors that had been through anything like that before, and the other investors we would meet, we couldn't figure out what the heck was going on, and then we figured out it was flight from Beaumont that changed that market. So we didn't lose money. We got out of our properties. We were able to give a return to our investors, but it was scary there for a while. So I wouldn't recommend Beaumont. But Texas itself is a great state to do business in.
What's your information source when you're looking for these emerging markets? Are you looking in the Wall Street Journal? Is it like public announcements, or do you have like some other way to keep your finger on the pulse of what's going on around the country, Dave?
Yeah, there's a bunch of things we do. We look at magazine headlines, you know, top 10 places to move your business, top 10 places to retire, top 10 places to raise a family. We look at, you know, those top 10s, and usually 1 or 2 markets will be in each of the lists. So those will go on our radar. And when I say go on my radar, the next step is it's called the Economic Development Committee, and find out what they're doing in a market that goes on our radar. We do that. There's a lot of different publications that you can get for free. Like Commercial Property News, Multifamily Executive Magazine, Apartment Finance Magazine. You know, all you got to do is sign up, and they'll send them to you for free. And the best thing is they'll give you, there's usually like a section on demographics. You know, what are the hot markets right now and why, or what are the markets that are cooling down and why. So they'll have a little information there. Your broker contacts are great places to get information. You can, you know, sign up with CB Richard Ellis. You can sign up with Spalding, Trent Western. And they spend thousands of dollars for demographics, and they'll be happy to share them with you. Hendricks Partners or Berkadia puts out this nice big report on the 50. They're what they consider the 50 top markets in the U.S. So we read all that stuff, get markets on our radar, and then when we choose a market and we know that we're going to go in and we're going to, you know, get 3 to 5 properties in that market, we'll go to reis.com, REIS.com, and we'll pay for information. We want to make sure that, you know, we want to hedge our bets and make sure that, like, we're right on. And Reis also educates us on the submarkets as well, because every city has submarkets, and they always perform in a certain rotation, you know, and you want to stay ahead of the rotation. You want to be buying in the submarket that's out of favor, but yet it's the next one that the herd's going to go to. So you get in for good prices, and then you sell for even better.
Nice. I'm blown away because you're talking about timing the real estate market, and it's so funny to hear people in the mainstream or, you know, coming from places of ignorance say, oh, yeah, you can't time the market. But it sounds like that's exactly what you've been doing now for, a number of years, right, Dave?
18 years.
Nice.
Yep.
All right, let me switch gears here just a little bit. And I'm curious because here in Chicago, across my desk, I'm always seeing they're on the smaller side, 20, 30, 40, 50 unit, but they're vacant buildings. Can you just talk about if you have any experience buying vacant buildings and how you might price that or go about looking at them, or maybe you have a suggestion to stay away from them altogether?
Yeah, here's the thing. If I do have experience buying properties that are near vacant or very low occupancy, and it is just a pain in the butt. You can make a lot of money doing this. I teach how to buy momentum. There's two different types of properties you're going to buy. You're either going to buy momentum play or you're going to do a repositioning, which is a vacant building or very low occupancy. Momentum plays cash flow at closing. And if you buy right with good value add and time the market right, you can make a lot of money quickly. Repositionings, you can make a lot of money quickly as well because you should be getting in at a very good price because you're assuming all the risk. You've got no money coming in, and then you got to figure out that the money that you have is going to do the job. The two reasons that repositionings don't work is the investor runs out of money, or they hire the wrong management company, or they try to manage it themselves, which is even worse, the construction aspect of it. So on the repositionings, we actually teach a repositioning bootcamp. Well, we used to. We don't do it anymore, but my advice on the repositionings is you start small. You start at a 3 to 6 unit property, and then if you haven't done any before, if you have experience, then you can just go for it. But if you don't, start 3 to 6, and then with that experience, you jump up to the next level, which is like a 10 to a 30, and from that you can jump up to a 40 to a 70, and from there you can jump up to 100 plus. And we went up to as high as a 400 unit repositioning. That was at 40% occupancy when we took it over, and I would not wish that on anybody. I thought it was a 3-year deal. It ended up being a 6-year deal. It was one of my first big repositionings. I jumped a little bit higher, a little bit faster than I thought because I just thought I could do it. And you know what? It kept me out of a lot of momentum plays because I didn't have the time to be searching for other great deals because I was so focused on this other property. My advice to people that are just starting out is don't do a 40-unit empty building or a 20-unit empty building. Start with a 3 or a 6-unit empty building and work your way up from there. But really what you should do is start with a cash flowing property, get some momentum plays, get some experience, get some success, and then do a small repositioning. And then from there, you can have a ratio. At any given time, you should not have more than 30% repositionings in your portfolio if you want to be a little risk adverse. And that's what real estate investing is all about. It's risky. So it's all about lowering your risk and having calculated risk.
I'm wondering, Dave, what is your highest value activities? Like, what does the high value day look like for Dave Lindahl? What are your activities, and what would you consider the things that you cannot replace with assistants, management companies, et cetera? What would be, give us an example.
I was fortunate at the age in my late 30s to be accepted into an executive MBA program over at Harvard University. So I spent 2 years over there going through their program, and it was awesome. So now I'm an alumni. I could not have gotten into that program if I was the 19-year-old kid in the rock and roll band. One of the things, and I get to go back to all these different events that they have and all these different additional lectures and teachings. And being in Boston, it's great because it's right down the street. And I'll bring my, members of my company with me, and I'll bring students with me at different times when they're at the office and there's an event going on. We're at this event, and the title is Why Companies Fail. And after we listen to an hour-and-a-half lecture, I brought my entire company. After we listen to an hour-and-a-half lecture, the number one reason that businesses fail is that the owner or the CEO cannot raise money, doesn't have the ability to raise funding. And the reason is because you need funding for everything. If you're going to scale and grow your business, you need funds to do it. It doesn't matter how much money you have. And a lot of real estate investors start out with very little. But funding is the key thing. And when you're funding money, you can't have somebody else fund money for your deals because people need to know you before they're going to give you their money, They're just going to meet you and hand you over a check for $50,000 or $100,000. You need to build a rapport with them. They need to know who you are. You have to build a slide deck and explain why. Even if you're just starting out, why you have the ability to give them their money back, number one. And number two, why you're going to be able to get the return that you think you're going to get. And if you're just starting out, you show them all the education that you've gotten and the team that you've built because, without a team, you can't do it anyways. And if you're doing the business, you find out what you have in common with this person other than real estate or real estate investing, and then you focus on that for a little bit of time as well. So commonality, building rapport, building trust, and raising money. That's my number one priority. And like I think I said earlier during this podcast that we've raised over $100 million in that amount of time that we've been in business. Number two would be systems, or just overseeing the systems or creating new systems. Because systems is what makes it all work, and systems and processes, and it gives you the ability to scale, gives you the ability to replace somebody when, either a life event happens to them or they move on or maybe they're not working out. But the systems and processes allows you to, move people in. The great thing about my company is I mean, people stay here for a long time, which is good. I had a CEO. I'm always being coached by people. I had a CEO coach come in like a year and a half ago, and I brought my inner circle in. There's like 8 of us, and he says, okay. He says, so what's your turnover? And now I've got 3 different companies here, and one of them has inventory. And he says, so what's your turnover? And I said, inventory turnover? And he said, no, personnel turnover. I said, personnel turnover? And then Jeannie next to me says, personnel turnover? She says, nobody leaves here. She says, we're one big family. She says, nobody leaves unless they're asked to leave. And that made me feel really good, especially the family part, because we believe, we're all part of this one big family, and we're just working our way through life together, and hopefully the things that we're doing are not only benefiting us, but more importantly, they're benefiting our clients, which our clients are in our main business, which is the investing in real estate. Our main client is our tenant. If we're not supporting our tenant and giving them a good, safe place, good, safe, clean place to live, then we're not doing them justice. And on our education business, we have a motto here. It's our number one core value is that we're not successful unless our students are successful. So we're always looking for, what's happening in the marketplace to help students get over things that are preventing them from doing deals or being successful after they've done a deal.
So you mentioned before you do some deals with students. What would be the hit rate? I kind of have a similar business model, Dave, and, a lot of students or a lot of people who are in the network try to bring deals, just don't work compared to the number of people that bring deals that work. So, I mean, what does that ratio look like, and what things, quickly could you suggest to somebody who is going to bring a deal to you or anybody in any market for, help, support, funding, et cetera?
Yeah, we've got the amount of deals we do with our students is about 20%. Not that I wouldn't want to do more. I would, We do get a pretty big organization here of acquisition people that go out there and find deals. I mean, our primary business is real estate acquisitions. But yeah, we get about 20%. But what we've like you said, a lot of the deals don't work. Even after they've been educated, it's like, okay, go out and do it, okay? And they know they just don't do all of their homework, the things that they've been taught to do. So what we did is we came up with how to submit a deal package. And how to submit a deal package just step by step tells them the information that they need to submit to us in order for us to evaluate the deal. Otherwise, everybody's just wasting their time, So part of that package is a one-page executive summary explaining why this deal is a deal based on your numbers. So basically it says do your numbers, and tell us where you got those numbers. That's the most important thing. Justify those numbers.
Nice.
But we've done some really good deals with students. I did a deal, I mentioned Durham, and one of my students, he brought me that deal, and we came out on the street to our investors with 11% cash-on-cash return. Typically, they look for an 8. And we knew coming out of that deal that it was going to be a 13, but we just didn't want to come out that high on the street with that deal. So we had 11. We're actually giving them, a year into that deal, a 17.4% cash-on-cash return. It's just a smoking deal. Student brought that deal. That was a good one. The one in Pensacola was also a student deal. That one's giving a 14% cash-on-cash return out. So that's a good one. So yeah, I've got a couple of students I do deals regularly with, and I get students that will do some one-off. See, they'll bring us a deal, they'll do it with us. We'll take them, we'll be partners. So they're involved in all major decisions and everything that gets done. And it's like, okay, I got it. And then they go out and do their own deals, which I'm very happy with because that's why we educate them. We don't expect them to come back and do deals with us, but they're out there doing their own deals after that, and they don't have to, there's no splits, and they get it all. It's a beautiful thing.
Nice. So, Dave, you've been in the business about 18 years. We've had record low interest rates for that period of time. What effect, if any, and what preparations have you done or changes would you have in mind if interest rates rise significantly? It's going to change the Trinity, the 8% cap, 12 cash on cash.
No.
I would assume. No?
No. It won't change that Trinity because you have to have those numbers in order to get the cash flow you need to bring investors into your deal. But I'll tell you how we're hedging this is when interest rate goes up, that means that cap rates go up, which means that the value goes down. When cap rates go up, values go down. Just by a simple, if you get a cap rate of a 6 and it goes up to a 7, that number is in the denominator of the equation. So there's 2 ways to hedge that. Number one is to get a good value add where the net operating income is going up as well. So if net operating income goes up, that will hedge against cap rates going up. But you really want that net operating income to be your bonus for buying right. So the second thing we're doing is we're only using financing that will allow us to assume the debt, and we're getting into 10-year debt. So 10-year debt meaning it's a 10-year balloon amortized over 30 years, but it means that we can assume it out to the next guy. So if interest rates go up, like in year 4, year 5, and all of a sudden they start shooting up, well, I've got a deal at 4.5% if interest rates are 7, and then I can assume it to you. So that's very attractive. That's how we're going to get out of these deals. That's our it's called disposition. That's our disposition strategy.
Dave, I'm going to switch gears a little bit, and we're going to wind down here. I'm going to ask you the questions we ask all of our guests, unless you had any other items that you'd like to add based on what we talked about.
Nope, I'm good. You got me talked out.
Cool. Yeah, I got like 5-6 pages of notes here, record-breaking amount. Everybody who listens knows I do that every episode. So, Dave, to you, who is the most successful real estate investor or developer and why? This could be someone you know personally or publicly, dead or alive. The important aspect of the question is why you believe they're successful.
Let me give you two. First of all, the most successful investor I know is Sam Zell, and he's out of Chicago. You know, they call him the grave dancer. He buys properties when they're low, and he sells them when they're high. And he's a multi-billionaire. He's done it all for real estate, and now he's buying in different countries. So he's probably the most successful I know. And then, but I want to say my very first mentor, his name is Mark Stovall. He's no longer with us, but he owned, I think it was 3,000 units, but he taught me how to be a conservative investor. You know, he taught me how to look at value add. He taught me how to look at deals. He taught me how to I remember I got him after my 5th property. So I've got 5 multifamily properties. And he was a hard money funder. And the banker who I said, do you know any hard money funders? I need to fund another deal while I was at a closing. He said, yeah, there's this guy down in Cape Cod. His name's Mark. He's kind of semi-retired now. He'll only do business with you if he likes you, basically. So I wanted him to like me when I was down there because I really needed money for this next deal. And so I went down and I was talking to him. And fortunately, we hit it off pretty good. And he said, yeah, if there are any questions, he says, let me know. I'll be happy to mentor you through this process if while you're just starting out. And he said to me, he said, I will mentor you unless I find out that I give you advice and you go against it. And then there's no reason for me to mentor you anymore. I was like, okay, I get that. So I come to him with deal number 7 and I say, hey, Mark, take a look at this deal. It's a 3-family. And he says, why are you buying that deal? I said, look at the cash flow. He said, yeah. He says, but it's a marginal property in a marginal area. I said, yeah, but look at the cash flow, and I'm getting it for a low dollar per door. And he said, no. He says it's a marginal property in a marginal area, which means that when the market changes, you'll have a marginal appreciation. He said, not only that, you'll have marginal tenants in there that are going to kick the crap out of that property, and you're going to have a lot of maintenance costs for that property. So it's never going to cash flow at the amount that you think it's going to because of that. He said, Dave, you need to focus on good properties in good areas. He said, because good properties will bring good tenants. They'll appreciate a lot faster or a lot higher in the good markets and you'll make more money. He says, yeah, it's going to cost you more per door, but it'll certainly be worth it. But the most important thing, he said, was if the market all of a sudden turns on you quickly, he said the first people to lose those jobs are the people in the marginal properties. He said the people that will maintain their jobs are the people in the good properties because it's higher rent and they'll be able to afford it, number one. And number two, he said you can always sell a good property in a good area in any part of the market cycle. He said, but a marginal property never sells in a down market when you need to sell it most. I was like, oh, okay. So he really taught me the nuts and bolts of being a conservative investor and, and what to do and do it right. And that was what got me up to 8,000 units. When I surpassed his number of units, it was kind of like an emotional time for me. Because here I am surpassing Mark, my mentor. Now I own
wow.
every day. Yeah, that was pretty cool. He ended up with Parkinson's disease, unfortunately, and he survived for a good 6 or 7 years with that, and it was awful. But,
sorry to hear that.
Yeah, it was too bad. He was a great guy. He loved everybody. Everybody loved to be with him, and he's just he was like your grandfather. You could just sit down. He had so much great advice to give, and he always gave it.
Next question, 2 or 3 life-changing books, real estate, business, mindset, success related. Could be your books, could be other people's books.
Yeah, I wrote a really good book called Emerging Real Estate Markets. I love that book. That was number 1.
I love
the first book I ever wrote. The book that got me started was a book called Fortune Beneath Your Feet by a guy named Kessler. That made me realize, wow, there's, I could follow the system and I could buy one property each year for 20 years. And then I think it was by year 20, you'd own them all free and clear. Little did I know that I was going to own 20 properties, in 2 years. But that was the first book that got me started. And I love books like Raise the Bar, The Magic of Thinking Big, because, it's a numbers game, but it's also a head game. And the stuff that you're feeding inside of your head. And I learned this through Earl Nightingale. He's got this great, he's dead now, but he's got this great course from Nightingale Conan called Lead the Field. And I used to listen to it every year for like 8 years, and now I listen to it every once in a while. But it's just great information to feed your head. The more positive things you feed your head, the better you're going to do. The more you educate yourself, the better you're going to do.
That's great. I grew up, I guess Earl Nightingale, Lead the Field. I was probably 8 or 9 when my dad, he was playing that all the time. And we would bust his balls, and then finally I come to appreciate it, and now I have that on my shelf, and I have, Acres of Diamonds, I think was in, another one from back then. He would reference that a lot. But, that's great.
The Stranger's Secret. He's got another one called The Stranger's Secret. That's awesome. My dad used to listen to Johnny Cash and Burl Ives, the guy that used to do Santa Claus or Frosty the Snowman. But you know what? Today, I love Johnny Cash and I love Burl Ives. It's weird.
Nice. So, Dave, if you could share the crown jewel of wisdom with your 18-year-old self, what would that be?
Educate and execute. Educate and execute. You can learn, I tell people all the time, you can have all the skills, you can have all the knowledge, but if you don't go and use it, then it's worth nothing. So, there's always somebody that's done it before you. There's really nothing new in this world. Every once in a while with new technology, if you're a technology geek, there's new stuff. And there are kids up here in Boston, MIT, and out in San Francisco that are inventing great things. But in real estate, there's not a lot of new things going on. You just find someone that's done it and then educate yourself on how to do it. And then go out and do it. That's the most important thing. Go out and do it. So when you learn something, put it in your calendar for the next week to do it. There's a great book called The Compound Effect by Darren Hardy. And it's all about doing the little things, but doing the little things every day, and they turn into big things.
Nice. Yeah, I recently read that one twice, I believe. So I'm heading up to Boston here in a couple weeks to come to your Ultimate Partnering event, I believe it's called, right? I'm looking forward to that. It's going to be my first Dave Lindahl experience there. So you want to tell me about what to expect?
There's going to be about 800 people there. Most of them are alumni students. There's going to be a lot of newer students as well, like yourself, coming to one of our first events. We call it our partnership event because there's alumni students that have gone out and made a killing, and they're looking to use newer students as bird dogs because they know they've been trained properly, so they'll create partnerships. There's people there that have deals, and they're looking for partners for their deals, There's people there with different type of business ideas, and they'll network business ideas. So it's really networking. During the first half of the first day, we do what's called speed networking. Everybody has 45 seconds to talk to the person across from you, tell them what you do. They have 45 seconds to tell them what you do. We do this for like an hour and a half. You get in as many people as you can, and what the good thing is you've got a few targets for the weekend. You're going there for a specific reason to meet specific people, and on day one you've met them. So you know who you're going to be taking out to lunch or dinner or all that. And then then there's networking after we do the education every day, and so it's a lot of fun. So we educate. This year we're going to educate on emerging markets and how to actually pinpoint neighborhoods in emerging markets that are emerging and when to get out of them. We're going to talk about storage. We talk about multifamily. We'll be inducting people into the Hall of Fame. We're giving away a BMW this year. Last year we gave away a Mercedes. The rabbi won it. That was awesome. It's just a great fun event. 3 days in Boston in August, and it's awesome. And the hotel is right in Copley Center, which is the center of the city. It's a good time. So you'll get educated, you'll network, and you'll meet some great people. And it's people doing deals. One of the things that we get from our students, especially the first time, is it's like, wow, there's a lot of people doing deals here, at your events. And it's like, yeah, because, we've got a system that is born from people doing deals. So you meet some really, really good quality people. And then thirdly, you just have a lot of fun.
Just to put
if anybody's interested in that, there's a website called Ultimate Partnering and the number 8. So Ultimate Partnering and the number 8.com, and you can look at that event there. And also, if you want a free book, I'd be happy to give you a free book. I wrote a new one called Massive Passive Income, and you can get that on Dave's with an S, davesfreebook.com, and you can get that for free, davesfreebook.com.
Just to put you on notice, there's no need to mention that BMW on any future, promotions because I'm going to be the one that wins that one, Dave, so you don't need to mention it anymore.
Yeah, it's pretty. Everybody gets the key. Everybody gets a key. And actually, the early bird special is going on right now, so you get 3 keys to the car when you get in before the early bird special.
I thought I thought she was doing something special for me and giving me the extra keys. Oh, man. Cool. Well, do you have any other contact information beside the 2 websites you had mentioned here that you'd like to share with the audience, Dave?
Well, if anybody wants to call the office and just ask some questions, you can certainly do that as well. The office number over here is 781-878-7114. You can talk to my mom. My mom's been here. We grew up in the fish business many years ago, and when the fish business closed, or actually this education business was started by me and my mom up above my garage because that fish business closed. She got replaced by a machine. She was a fish cutter on the Fish Piers of Boston for 27 years. So she's here. You can talk to my mom. She'll tell you all about it. Or Jeannie, she's the girl she's my investor relations coordinator. that $100 million has flown through her office, so she can give you some tips on how to raise money as well. So yeah, give us a call. If you're in the area in Boston, just south of Boston and Rockland, feel free to stop by. We've got people that, if you give me a heads up, I'll take you out to lunch, but we've got people that will just stop in and say, I didn't want to call ahead because I wanted to surprise you so I could really tell if this is really real or not. It's like, okay. It's like, Jeannie, give him the door, and then.
Oh, man.
That's the time. It's real.
That's cool. Well, Dave, this has been a great episode. I really appreciate you taking time out of your day to share with our audience here, and I thank you for coming on.
Yeah, thanks for having me, Dan. I appreciate it. It's nice speaking with you.
Cool. And thank you all for listening to this episode of the REI Diamonds Show. Are you receiving the new episode notifications? If you'd like to, you can sign up at www.reidiamonds.com. There's also places to suggest guests on that site and also submit deals in the markets that we operate. Again, that website is reidiamonds.com. Thanks again for listening. Dan Breslin here, and I'll catch you next time. Remember, here at the REI Diamond Show, we're dedicated to helping you increase and protect your net worth.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.